Well, hello everyone, and welcome back once again to module number 2. We're now talking about, we're in lesson number 4. We're talking about accountants. Accountants are one of those things that, people need. They don't spend a whole lot of time researching or understanding the full value of an accountant. This came to light for Joanne and I many years ago when we owned and operated the campground. One of the first accountants that we ever hired to fulfill the role of accounting for us, because we didn't know what we were doing, was a nice gentleman in the neighboring town, and we just took all of the paperwork to him at the end of the year. He did the tax filings, told us when to come pick up all the paperwork. We went and did that and paid our bill and filed our taxes that year. We didn't know any different. I then came across another gentleman who was an accountant who didn't live too far from us, and I actually played hockey with him. That's how I got to know him. And we decided to make use of his services. And he was a very big, successful accountant from the city of Toronto who moved out to small town rural Ontario and just wanted the easy life, get away from the hustle and bustle of the big city. So we became good friends, and we gave him our business. The big difference between, his name was Steve, the big difference between Steve and the other accountant was that Steve cared. And I say that in a way that I don't mean to say that the first accountant didn't care about people, but he certainly didn't act like it in his business. Steve would ask us questions, challenge us about decisions we made, how we were operating the business. When it came time to look to the future, we were going to incorporate and change it from our own personal names into a corporate name. He asked us, I can't remember exactly, what, but do we want to pay the capital gains tax now, or do we want to pay it later? And I honestly didn't have a clue what he was talking about. And I said, well, what do you think we should do? And we trusted him. And the way he structured it, when we bought the business early on, we had to pay a little bit of pain and pay some tax at that point in time when we created this new corporation. But then years later, when we sold that corporation, or when we sold the business, we actually sold the corporation, and it saved us thousands and thousands of dollars, tax dollars, and forever grateful for the way that he had the foresight to help us structure our business. That was the difference of having somebody work for us rather than with us. We then started to get into the game of investing in real estate, and Steve was very helpful with us initially, and I think we owned about maybe 15 or 16 doors at the time. And Steve asked, how many doors are you planning on buying? So that's when I explained to him the 3-tier structure of having the corporations and how many doors we were planning on owning. And at that point in time, I have to give him credit. He said, you know what? That's getting a little bit beyond my area of expertise. I think you should start to look for a different type of accountant. So he helped us find our next accountant. He couldn't and shouldn't recommend any one individual, but he did recommend a few people. And then he told us this is what we need to go out and we need to ask questions and interview them. One of the most important questions for us at the time, because we had this 3-tier corporation structure that we still have to this day, not every accountant or lawyer is comfortable with that type of structure. So that was one of the questions that we would ask. We'd first of all say, how much experience do you have working with real estate investors? Do you own any real estate investing yourself? And then how comfortable are you with the 3-tier structure? Of the 3 accountants that we interviewed, one said he wasn't very comfortable with it at all, had no experience, and didn't have any real estate holdings himself. The second gentleman, he had some real estate holdings and said he's heard of the 3-tier structure and he would love to learn more about it, which is great, but not at my expense. And then the third one was in the city, which was a little bit less convenient for us, but we liked the gentleman, connected very well. He was very reassuring about the 3-tier structure, etc. So we used his services for a couple of years. And then one year, Joanne and I went in for our annual review, and we came out an hour later. We were very rushed. We had 3 corporations that we wanted to have reviewed, And after the end of the 1 hour that he had set aside for us, we left the office and we just sort of looked at each other, and I said, I don't know about you, but I feel like I was just spanked by my accountant. And she goes, yeah, that wasn't very comfortable at all. So we quickly fired him, and we started to look for another accountant, and we came across a gentleman. His name is George Doobie. Highly recommend him if you're operating in Canada. If you're operating out of the U.S., Mr. Wheelwright, who is the one of the Rich Dad advisors for Robert Kiyosaki, highly recommend him as well. So with George, the big difference with him is that he was an active investor, still is an active investor as well, and George actually took a lot of the same real estate courses that I took. So we were operating on the same plane, and he understood what our plan was, so that, you know, if we had a bad year, the numbers didn't look all that great, he didn't panic, he didn't make us feel like we were doing anything wrong. So that was the big difference right there. Now, so I've given you a couple of tips already as to how to look for and what you want in an accountant, and it's really important to have a good accountant on your team. One of the key things is they should ask you what your plan is, and you should be prepared to share your plan with them. Have a very clear, concise plan, all the way through to how are you planning to divest yourself of these properties in the future, or are you planning on handing them off to your family? So there needs to be some estate planning set aside there as well. As I mentioned, you want them to work with you, not for you. That goes not only for your accountant and every aspect of your team. You want them to be working with you. One question I get asked frequently is whether I should incorporate or not. And that really depends on your plan. It depends on a lot of things for you personally. If I was, for example, going to be owning maybe 15 doors, 20 at the very most, I probably would not incorporate here in Canada. If I was doing it in the US, I would absolutely be incorporating, simply because there's a much greater chance of being sued. The liability down there is much higher. So the way that the corporate structures are structured in the US market is very different than it is in Canada. So you want to make sure that your accountant understands what your plans are and that they put you into the correct structures. If you are outside of the US and you want to invest in the US, again, you want to make sure that you're doing it properly. You want to make sure that you're dealing with an accountant in Canada who understands the system in the US, understands how the money is going to move back and forth across the border between the two different jurisdictions. And even if you're an American in investing in the States, but different states, you need to make sure that things are flowing properly as well. So it's extremely important that you make sure you have the right structure in place, and that all starts with having that really good conversation with your accountant and your tax lawyer, but they need to know what your big plans are as well, so you get it started right from the beginning. Some of the questions that you can ask with the lawyer or with the accountant is the pros and cons of incorporating versus not. It's extremely interesting how they have different views and perspectives on this. What's their view and perspective on depreciation? Because you ask 10 accountants whether you should depreciate your property or not. 5 will say yes, 5 will say no. So you want to understand what their perspective is as well. Even little things like you know, the cost of taking a course, you know, the investment that you made to take this program right now, are you able to use that as a tax deduction? If it's the company's in your personal name, then you may not be able to deduct it. If it's in your corporate name, you're more likely to be able to deduct it. So these are the little things that you want to ask, but these little things can add up to major tax savings for you. You don't want your accountant to do your bookkeeping. You want your accountant to do your tax filing and tax strategy. So who's going to be doing your bookkeeping? Does the accountant and their company offer bookkeeping services? If so, how much? If not, or even if so, what programs are they using so that when you go looking for your own bookkeeper, that you're using the same program, so that at year end, when you hand over all of your files, there's not a mass confusion because you're using two different accounting packages. So you want to make sure you're all on the same page. You definitely want your accountant to be open to problem solving and helping you, well, perhaps challenging you with some of the decisions you're making, whether you're depreciating your property or not. You want them not to treat you badly or make you feel guilty, but to make you question and challenge you on some of the decisions to make sure that you're making the right decisions. That's great. You want to have an accountant do that for you. Another thing that you would like to have is an accountant that is open-minded and willing to come up with different solutions. So for example, we had a situation where we bought a property and my intent was to flip the property. Now this was a property worth over $500,000. And for a variety of different reasons, the flip didn't go the way it was supposed to go. It dragged on and dragged on. Eventually we decided, you know what? We're not going to flip this property. We're going to keep the property as a buy and hold. Now here's the challenge. We are incorporated. So when we're going to do something like a flip, an assignment, or lease to owns, anything that generates cash like that, that's what they call active income. And it's taxed at a lower, excuse me, it's taxed inside a corporation at a lower tax rate. So it's also, it's 100% taxable income. If you're going to do a buy and hold, you're going to hold that in a different corporation because it gets taxed at a higher tax rate. It's just the way the government works and the way the tax system works. So that's why it's really important to understand what your plans are for a property when you buy it, so you understand which corporation to place it into. Now in our case, as I said, we were planning on putting that property in, we were planning on flipping it, which means that we're going to be 100% taxable. We wanted to be at the lowest tax rate, therefore we wanted it into what we call an active corporation. The active corporation for us is our property management company. So we bought and we're holding the property in the property management company. Then we decided, well, we're going to hang on to it. Well, now we have it in the wrong corporation. And in order to move it from one corporation into another corporation actually is it triggers a sale. And where I live, we have land transfer tax. And the cost to us, not even the legal fees of doing the transaction, but just the cost of moving it from one corporation to another was going to cost us approximately $12,000. Now $12,000 on a $500,000 project, isn't a whole lot of money, but why spend $12,000 needlessly, right? So we scratched our heads, wonder what the heck can we do? How do we get ourselves into this challenge and so forth? Then the accountant said, why don't we close down the property management company as a property management company, open up a new corporation for the active property management company, leave this property in that corporation, but that's the only thing that's inside that corporation. So the property has not moved anywhere. And we just changed the name of the corporation from, it was ARCA Property Management. We changed it to ARCA 500. So it's a standalone corporation. The only thing inside that corporation now is that buy and hold property. So we didn't actually sell it. We just changed the name of the company. Therefore, there's no land transfer tax. Now, we did incur the cost of opening up a new property management corporation and moving the books over into that corporation. So in total, it cost us about $3,000. However, $3,000 was much more palatable than a $12,000 bill. So our accountant, because of his creative thinking, actually saved us over $9,000 that year. So we were very grateful. That's the power of having an accountant who cares about your business, cares about you, and works with you to help you with your business rather than just simply doing what you're asking of them. So that's the nuts and bolts of an accountant, the value of having a good accountant, how to find a good accountant. If you're starting off, definitely interview at least 3 accountants and ask them all the same questions and then see what their responses are with respect to those questions, and you can evaluate from that point moving forward. So I hope that was of value for you, and that's it for lesson 4. Lesson 5, we're going to talk about the value of a mortgage broker versus a one-time lender like a bank. So take care, and look forward to talking to you about all of the lessons on our live webinar coming up. And any questions, email those questions into kbeaton@arcarealestate.ca ahead of time so I can answer those questions. Or you can, if you're on the call live, you can ask the questions live on the call as well. All right, take care, and we'll see you later.